Hello, everybody. This is Professor Hassey, and this is our Week 7 video. I'm speaking to you live and in color from my office on the University of Laverne campus. I figured at least once this summer during our Accounting 203 class, I at least have one video from my office here on campus. The campus in the summertime is very quiet, not too many people around. We have some programs for international students. We have some programs for local high school students, but besides that, it's a very quiet campus in the summertime. Faculty are away, staff are on campus, but many of them work remotely in the summertime. And so it's a kind of a nice time of year for around to be on the campus because you're not bothered by anybody. But be that as it may, let's talk about week number 7. A couple of things have been happening this week. I have posted your final examination already to Blackboard. I know a lot of you are working on project paper and assignment 4, but the last piece of the puzzle of our Accounting 203 class has now been posted to Blackboard. It is due on Sunday, July 30th at midnight. One to note, there can be no extensions for the final examination. I have to have all postings in by midnight on Sunday, July 30th, because I'm going to put together the grades in the next few days after that. And so unless you have a dramatic story to tell me about a computer failing or whatever, please make sure your work gets posted by Sunday, July 30th. So right now, we're working on assignment 4. We are working on our project paper, and we are working now on our final examination. So many things to do in this next week. I'm going to be talking about a couple of things that are on the final examination: plan assets, current liabilities, and corporate accounting today in this video. I also will have another video coming about chapters 18 and 19, managerial accounting and cost accounting, to finish up our course. So let's take a look at our Blackboard right now and make sure we see where all the material is that we need to complete this week. Okay, so here's where we stand in class as we finish up week number 7 with one more week to go. A couple things to note. First of all, if you go to the course syllabus, schedule, and information file folder, you'll see a couple of things. First of all, and you don't have to do this right away, it's not due until August 2nd, but here's the link to our course evaluations, and I'll talk more about that later on in week 8. But these are evaluations, and many of you, if you've been students at Laverne for a while, you're inundated by surveys, evaluations, and all that sort of stuff. And this is the evaluation link for our class to give your feedback for this course. It's now available, but I wouldn't do that until you're finished with the course, because there's still a lot of work to do and a lot of things that I need to prepare for you in the next week. Again, we are right now, as I said earlier, we are now currently on our assignment number 4, which is about retail accounting and accounting controls, notably bank reconciliations. You're working on your 10K paper about the company you selected, answering those questions, and the final examination is now posted. Once all these are posted next Sunday, I will post the grades by Friday, August 4th to Blackboard so you can see how you did in the class. If you go to the assignments and final examination file folder, you will see the final examination posted in both PDF and Word doc format. You can do all your work on that examination, or you also, if you'd like to submit another file or 2 files or 1 file, you can do it on a spreadsheet as well. There are some problems that could be done on a spreadsheet. So either way, you're the boss on this. That's final examination. So assignment 4 you're working on and the final examination are now posted to Blackboard. Here's what I'll be discussing today in the week 7 balance sheet file folder: chapter 10, plan assets, chapter 11, current liabilities, And chapter 13, what is a corporation? Accounting for corporations. That's the subject of our video today. So let's get at it. One of the key things of a balance sheet, and one of the most valuable and are the greatest dollar amount, are the plan assets. These are assets that a company purchases, and those assets produce revenue. They produce the products or the services that your company are doing. So it's very important to account and understand the plan assets of a company. And this is an example here from our PowerPoint about chapter 10. You acquire the asset, and then you use the asset. The asset produces products, produces services. It could be equipment. It could be a building. It could be computers. It could be all kinds of things. What determines a plan asset is it has a lifespan of over 1 year, and it can be depreciated over that time. And that's why we have a decline in the book value over the useful life of the asset. That's called depreciation. And then at the end of the life of the asset, you dispose of it. You either sell it, you scrap it, you get rid of it. And that's the life of an asset. Many of you, if you work for companies, or even if you work for yourself, you're required to keep track of all your plan assets. And every asset that you own in your business has a barcode associated with it that keeps track of those assets for the company. And the key thing is, and this is one of the key things, and you'll learn more about this as you go further on in your business studies, that when you purchase a piece of equipment, you have a couple of luxuries developing there. First of all, the equipment is used to create revenue and cash flow, number one. Number two, because of depreciation, it allows you to incur an expense, reducing your tax liability because of that expense of depreciating the asset. And then finally, when you dispose of the asset, if the asset has any value at the end of its life, you can obtain a gain or additional income or cash flow from the disposal of that asset. So again, management of plan assets is huge for corporations and for any businesses. Depreciation. This is the main thing to get out of chapter 10. Depreciation is the process of allocating the cost of a plan asset to expense in the accounting periods. In other words, you purchase it, you determine the depreciation, and you expense it as depreciation expense. And many of you have done these entries already. The calculation of depreciation is a three-step process. What did you pay for the asset? What is determined by the salvage value? And that's an interesting concept. Many of you work for companies that have purchasing agents or have people responsible for buying the things that your company uses. Well, usually when you purchase a plant asset, piece of equipment, it's estimated how long that asset will last. Once that's determined, it also is estimated what you expect to get for that asset at the end of its life. After years of beating the hell out of it, what is it going to be worth at the end of its life that you either can sell and get some additional money, or you can just scrap it and write it off your books? That's called the salvage value. And then finally, this is all driven by the useful life of the asset. Now, who determines the useful life? Very simply, it's the Internal Revenue Service. The Internal Revenue Service determines the life of all the assets in an accounting system. We have depreciation schedules for every type of asset in existence. There are three main depreciation methods, and you need to be familiar with these: straight line, units of production, and declining balance. See, the IRS allows companies, kind of like inventory, when we talked about inventory valuation with LIFO and FIFO. The IRS allows companies to choose a variety of different ways of expensing an asset over time. So let's take a look at an example of this. You can either straight line it to depreciate it by what is called the units of production, or you can do what is called the declining balance. Each serve different purposes, each serve different types of businesses that can choose from these. So let's say we purchase an asset for $10,000. It's determined that it has a salvage value at the end of its life of $1,000. That means we're going to depreciate $9,000 over the life of the asset. The remaining $1,000 is left to what we can get at its end of its life. What is its accounting or useful life? It's 5 years. So we go to the IRS table, or our CPA firm tells us this asset can be depreciated over 5 years. And it's also estimated that this asset, this equipment, is going to produce a product, and in this case, shoes, of 36,000 shoes over its life. So again, to determine the depreciation, we take the acquisition cost and we determine those expenditures over the life. So we purchase the asset, let's in this case, machinery and equipment, buildings, land improvements, land. Land is not depreciable though. The only companies that can depreciate land are companies like oil companies or natural gas companies or mining companies. They can depreciate land because why? They're taking their resources out of the land to sell to their customers. So land is not depreciable for most business. So here's an example. CarMax paid $90,000 cash to acquire some land appraised at $40,000. And this is how they allocate the cost between land and building, because there was a building on that land. So let's go back to that entry to talking about depreciation. Remember, we had the first method was straight line. The definition of straight line is to take the cost of the asset minus the salvage value and divide by the estimated life of that asset. So in this case, our depreciation will be $1,800 every year for the 5-year life. So we'll be doing an adjusting entry every year at the end of the year, debiting depreciation expense and crediting accumulated depreciation. That's straight line method, pretty simple. It's the exact same dollar amount every fiscal year. Here's the units of production method. The units of production is based on how many units you plan on producing of that equipment over its life, and then taking the amount of units you produced in a given year and determine the depreciation. If any of you have copy machines in your office, this is the main depreciation for copy machines. How many copies? One year you might produce 10,000 copies out of a copy machine. Another year it might be 50,000 copies. The year that you have 50,000 copies, naturally you're going to depreciate more because you used it more. That's the units of production method. So here's an example. This is the same product we had at the beginning, where we determined that the salvage value of 1,000 is subtracted from the cost, and it's $9,000. And remember, we said that this unit was going to estimate to produce 36,000 shoes or units during that life. That means it's 25 cents a unit for depreciation. Then in this year, they use 7,000 units or produce 7,000 units. So if I take 7,000 units for this year times 25 cents a unit, which is my units of production rate, that means this year I'm going to depreciate $1,750. If the next year I use 8,000 units, I'm going to have a little bit more depreciation, kind of like that example I used earlier. That's the units of production method. And then the final one is declining balance. And why a lot of companies use declining balance is because simply you depreciate more in the early years or early life of the asset. And then as the asset gets older, the amount of depreciation drops. In other words, companies want to get more money back earlier. And that's the declining balance. So what the declining balance is for, again, this asset that we looked at earlier, you take the straight line rate. So remember, we used the straight line rate over 5 years. So that means we're depreciating on a 5-year asset 20% a year. What we do with the declining balance is we double the straight line rate. 20% times 2 is 40%. And that's how much we depreciate from the book value every year. So for example, In year one, we have a $10,000 cost. Notice we are not including salvage value in this cost or depreciation schedule. So if we double the straight line rate for this asset, that's 40%, we take 40% of 10,000. That means the very first year is $4,000 depreciation expense. Notice how much more that is. Then when we get to the second year, the book value of the asset goes from $10,000 to $6,000. Why? Because we depreciated $4,000 in the first year. So now in the second year, we take 40% of the book value, $6,000, and our depreciation is $2,400. Then we take the new book value at the end of year two, $3,600 times 40%, $1,440. But notice in the declining balance method, you're depreciating it much more in the early years. Companies like that, they can increase their operating expenses, thus reducing their tax liabilities on their revenue churned out by that asset. So it's a different type of depreciation schedule. So again, straight line is based one flat amount every year. Units of production is based on the number of units the asset is producing per year. And declining balance method is taking the straight line rate and doubling it and taking that as a percentage factor of the book value of the asset over its life. And that's the three methods that you need to be familiar with. And that's a key to plan assets. Whenever you start taking finance classes, the reason companies want to invest in assets is not only to produce revenue, but to get expenses, reduce tax liabilities. And that's the three main methods: straight line, units of production, and double declining balance. Now let's take a look at chapter 11. And the key thing about chapter 11 is mainly definition. What are liabilities? Remember, right now we're looking at the right-hand side of the balance sheet. We're taking a look at liabilities which create assets. And there's different types of liability. Remember, a liability is a present obligation to pay a loan or a debt into the future. That's a liability. And liabilities can be current liabilities, life of less than 1 year with no interest, or long-term liabilities with lifespans over a year, where usually there's interest involved in those calculations. Many companies like to have most of their liabilities current because they don't have any additional costs, no interest. But many times companies can't not have a lot of current liabilities because that means they have to pay it back pretty quickly. So it's that balance of long-term and current that how company managers must manage their financials. And that's one of the key areas of study if you ever go on to get an MBA degree or a finance or an advanced degree in business. You learn how to strategize and how to manage the balance of long-term and short-term debt in a company. Liabilities can sometimes be uncertain. In other words, you know you have debt, but you got to make sure you know who you owe money to and how you pay that back. Okay. So remember, when you have different types of liabilities in a business, and one is sales taxes. One of the key revenue generations for local and state governments is sales taxes. They provide the necessary revenue to government to pay for services, sales taxes. And when you have a business where you're selling a product, you have to pay sales tax. It's called sales tax payable. So let's say I sell something for $6,000, all right? And I include $300 in my retail price as a sales tax rate, which is in this case 5%, which is I wish those days were back. In Los Angeles County, the current sales tax rate is 10%. So that means I record the sale as $6,000, but I take in $6,300 of cash, of which revenue is $6,000, and I have to put the rest in a sales tax liability account, $300, which eventually at the end of the quarter, I have to send a check to the state government for the sales taxes I collected on my sales. That's as simple as that. But for any type of business, keeping track of sales taxes is a very important task. Also, as we've seen in our other areas of our study this summer, unearned revenue, the recording of recording revenue in advance, and then once that revenue is provided, doing the adjusting entry. Then there's also what is called notes payable. When you borrow money, let's say in this example, we borrowed $2,000, but because it's a note payable, it has interest. In this case, wow, 12% interest, and that loan is due in 60 days. So at the end of the loan period, you not only have to pay back the $2,000, in this case on November 29, you also have to pay back $40 of interest. The interest is the cost of borrowing the money and to get a return to the institution, in this case, a bank, that lends you the money. And many of you know this. If you ever borrowed money for a car, if you ever taken out a student loan, yes, you get the principal on that loan to pay for your car or your student tuition, but also you have to pay a fee, and that fee is called interest. And all liabilities have interest if it's a long-term note. Another huge liability for companies is payroll. Yes, payroll. That's why we have many companies in America using payroll services like ADP to process their payroll, because it can be very expensive to hire people and to keep track of all this. Remember, when you make a paycheck to an employee, you have to withhold federal tax, state and local tax, health insurance, retirement or Social Security taxes, Medicare. All these have to be withheld that you have to keep account of. Then every quarter, you have to send these various taxes to your state and local governments, to your health insurance company, to your 401k or retirement plan, to cover all that. So a company has to keep track of all this. It's crazy. Social Security taxes. Everybody who has, if you don't work for the government, you work for a private corporation or a publicly owned corporation, and you have a retirement called FICA. It's required by law that they withhold 6.2% of your pay and 1.45%, so that's 7.65% of your pay is withheld by your employer twice. Your employer pays and you pay, and all that money goes into your retirement plan. So when you retire, hopefully when you're 65, 6, 7, 8, 9, whatever, you have that money available for Medicare and retirement. You pay state and local taxes, the withholdings. Remember when you file a tax return, you tell them what you earned, less what they withheld in taxes. If you withheld less than what you have to pay a tax, additional taxes. If they withheld more than what you owe, you get a tax refund. Remember those games we play every April 15th. And then there's voluntary deductions, pension funds, savings accounts, union dues, health insurance. But as you can see, I'm not going to ask you to do journal entries. Remember I said at the beginning, liabilities is all definition, but this is a journal entry recording a payroll. We have salaries and then all the withholdings. And at the end of the period, the government or you have to make sure you pay all those withholdings to those appropriate parties. Now you understand why we have ADP and payroll services. This is a huge, huge undertaking for many businesses. So a key thing about liabilities, you just have to know the definitions, is what's involved there. If it's an interest-bearing liability, you have to calculate what the interest would be over the period of the loan. If it's a non-interest bearing, like a sales tax or payroll taxes or accounts payable, You have to just understand when you have to pay it. Many businesses have been closed over the years by being late on their payroll tax and sales tax payments. If they're late, companies or governments can shut a business down, and that happens more than you think. And the last part of our lecture for today is equities. In the case of corporations, stockholders, the final piece of the capital structure of a company is the equity position of the company, mainly the ownership of your business. Are you privately held, or do you issue stock, and are you publicly held? Remember, if any of you watch Shark Tank on TV, those are privately held companies looking for investors, the sharks, to help them run their organization. But it's a privately held business. When companies get to a point where their private funding does not meet their needs of their business, they go out to the markets and issue stock and become publicly held. That requires a lot of capital and requires a lot of expertise. As you are seeing in your Form 10K project paper, companies can be very complicated. And being publicly owned, you have to file these forms like the 10K form to make sure everybody knows what you're doing. And that's important. And that's a key part of stockholders' equity. Remember, a company is set up in this way, and it's called corporate governance. This is a big deal, especially in business studies. Who reports to who? The stockholders own the company, the publicly held stockholders. They hire or they select of their group of stockholders a board of directors. The board of directors select the management team of the company, hire them. And that management team goes out and hires and runs the rest of the employees of the business. So remember, the chief executives of a company report to the board of directors, who are representatives of the stockholders. That's a very important understanding how corporations work. It's called corporate governance. The advantages of being a corporation. You have a separate legal entry. You have limited liability, and that is huge. Let's say I have a business, I own a business, and I'm a sole proprietor. I'm not incorporated. I'm just my own business. I'm a sole proprietor. I own the company. If somebody comes into my business and sues me, either I did something wrong or they got injured, whatever. If they sue me, because I'm a sole proprietor, I have unlimited liability, meaning they can sue me, the business, and they can sue me individually. They can take away my house. They can take away my personal assets. That's why so many people become incorporated. Because if you're a corporation, you have what is called limited liability, meaning they can only sue the assets of the corporation. They cannot sue the owners of the business. So if you own stock in Apple, you can't get sued. If you own stock in a company, you can't get sued. Now, they can sue and take away the assets, which will probably influence your stock value, but they can't sue you individually. And that's why we have so many companies now in the 1990s on that have become LLCs, limited liability corporation, LLPs, limited liability partnerships, subchapter S corporations. Those are all companies that manage like a sole proprietor, but are incorporated as corporations because the main reason is limited liability. Now, the disadvantages of running or having a corporation that's public, and you see it with your 10K, lots of regulation, lots of reporting, lots of liability issues you have to make sure everybody's aware of that you do business with. And also, corporations are taxed twice. They're taxed on the net profit of their corporation, and then when they take those remaining profits and distribute them to their shareholders in dividends, those dividends are taxed on the shareholders' return as income as well. So technically, corporations are taxed twice. It can be a big hassle. Stockholders of a company have the right to vote on the company's management decisions, called proxy votes. They have the option of selling or purchasing additional stock. They can get dividends, and they share in any assets remaining in liquidation. If a company goes bankrupt or a company is sold, they get whatever is left after all the creditors and liabilities are paid. Those are the rights of the stockholders. Here's a stock certificate. And yes, the Green Bay Packers are a publicly owned company. That certificate entitles you as an owner of, in this case, the Green Bay Packers. So when a company issues shares of stock, they receive cash, and now they issue stock in the market, and that goes on your balance sheet as a par value. So here's an example. Company decides to issue 30,000 shares of $10 par value stock for $300,000. So in other words, they go ahead, they go to the market, and they think, we think our stock is worth $10. Remember, to get that $10 figure, they hire accountants, they hire lawyers, they do due diligence, and they determine that their company is worth about $10 a share or $300,000. So they go to the market and says, anybody out there want to give me $10 for every share of stock? And wow, people buy it. They think the company is good. They consider that maybe a cheap investment. And they get the cash, and now they start the business. Debit cash, credit common stock. That's how equity begins for a corporation. You issue stock, get the cash, you're off and running. Now, let's say you issued the stock that had a $10 par value, but when you went to market, the people said, I think the stock is worth more. I'm going to give you $12 a share. So now you're going to get $360,000 in cash, but you're going to get $60,000 over the par value that you originally thought the company's stock was worth. Because that additional $2 is over the par value, you record that in an accounting entry as paid in capital in excess of par. It's still an equity account on the books as equity, but it's telling the world in your financial statements that you thought the company was worth $10 a share. But when you went out and issued the stock, the public gave you $2 more. Good for you. And you have to record it that way. So the equity section of a company's balance sheet has three different accounts. The retained earnings we have seen before. That's where your net profits, net revenue minus expenses and dividends go when you close the books every month. And then you have the values of the par value of the shares of stock outstanding. You have a line for telling the world that you got $2 more per share or additional $60,000 in paid in capital. So your equity section of your balance sheet is $425,000. That completes the capital structure. On the right-hand side of the balance sheet, you're now showing where your liabilities are, who you owe money to, both short-term and long-term, and how your company was invested. Who bought and what dollar values and what profits you've maintained so far in your business. That's the equity section of a company stock. One last thing in regards to equity is, how do you record the dividends that you pay out your shareholders? Remember, one of the reasons why somebody gives you money for stock is they anticipate the stock price to grow, and eventually they'll sell it and make a profit there called a gain. And also, maybe every quarter, every year, you give them a share of your profits called a dividend. Well, this is how this is determined. On January 9th, a $1 per share cash dividend is declared for this company based on 5,000 shares of stock. In other words, they're going to pay out $5,000 in dividends to the various shareholders that they have of the company. So to record that liability, remember they declare the dividend on January 9th. So they take it, a debit retained earnings. In other words, they take it out of retained earnings, the profits that have been accumulated in the company, and they credit dividend payable. We now owe $5,000 to our shareholders. Then finally, when the actual payment date comes, remember they declared it on January 9th. As of the January 22nd, they take it to, all right, who owns stock on January 2nd? That's the closing date or the X date. After January 22nd, if you buy stock, you're not going to get a dividend this year. You have to wait. But on January 22nd, you can get a dividend if you have stock then. And then the declared actual payment, when they actually write the check and send it to you, is February 1st. And then you debit the liability and you write a check for cash to pay the dividend. That's the process of dividends. You declare it on usually a few days at the end of a quarter or a year, and it's based on who owns stock as of an X date or a given date, in this case, January 22nd, and there's no accounting have to be done then. It's just who owns the stock on that day. And then on February 1st, we actually write the dividend checks to the shareholders of record on January 22nd, based on the declaration of the dividend by this company on January 9th. So that's how dividends work. And it's very important because a lot of us investors want dividends, and companies are obligated to pay those dividends to keep their shareholders happy. Well, there we go. We're up to date for week 7. Chapter 10, 11, and 13, those are key areas. In other words, chapter 10, you need to know how to calculate depreciation. In chapter 11 and 13, you need to understand the definitions of liabilities and the definition of what a corporation is and how it's created. These are all questions that are included in your final examination. And we will pick up the final area of our discussions in week 8 on chapters 18 and 19. So again, this weekend, ending week 7, you have assignment 4, you have the project paper, and the final examination due next week. Any questions, please let me know. We're off and running. I'll be available for any questions or concerns you have and any discussions on the work you're doing. Thanks, everybody. Have a great weekend, and we'll see you next time.